You've heard the expression, misery loves company. And apparently there are a lot of miserable people out there, and they're all over YouTube with videos. They're doing podcasts everywhere, and they are trying to convince everybody that they're all losers. And if you're thinking about investing in real estate, or frankly most of anything else, you too will be a loser. Well, let's look into that. Let's see how true that is, especially here in Las Vegas, because I think you're going to be surprised. I am Justin Miller, co-founder and principal at the Chong Miller Group. At the Chong Miller Group, we help people build wealth through real estate. We help people buy and sell homes here in the Las Vegas Valley. And please smash the like button, subscribe to our videos if you've not already, click the notification bell. Let's get into it. This is the February market update for single-family resale homes in the Las Vegas Valley. Now, first, I do want to make a note. Remember, in these videos, I take out those new construction properties that somehow got listed into the multiple listing service. New construction, even if it's being sold through the MLS, through the multiple listing service that is available to all real estate agents who are members of LVR, that is not a resale. And so it is not competing in the same manner that individuals who are selling their houses are competing. Right? Those are motivated properties, motivated by organizations that must sell. Right? Builders build homes, but they're not in the business of building homes. They're in the business of selling homes. And so they have to sell those properties. As such, they have a different motivation. Right? It's a group motivation that is different from what individual resellers may have when they approach the market. Individual reseller may wish to maximize their profits or wish to get particular terms on a deal that allow them to remain in their home for a while after a sale, or all sorts of other things. Builders, no, they're just looking to sell. So that different motivation means that new construction properties, even if they make it into the MLS, are a different population of data, and they should not be included. It means that the numbers that I present you are a little bit different than what LVR releases into their press release that gets picked up in the local newspapers and picked up by almost all other real estate agents who really do not know how to do a proper statistical analysis. All right, now having said that, let's go ahead and look into the numbers. Now it is February 7th as I have pulled this data and as I'm recording this video. I try to do these market updates on the 7th of every month because that gives me a stable data set to look into to see what happened during the prior month. So the data are for January of 2023, and we do month-over-month comparisons between January and December of 2022, and year-over-year comparisons between January 23 and January 22 in this video. All right, first number. The first number is a little bit of a surprise. Price. I don't mean the number is a surprise in the order I'm going through, but in terms of what this number actually represents. Median sale price for single-family resale residential in the Las Vegas Valley, $419,450. Now, kind of an interesting number. The reason it's interesting, well, everybody else is out there talking about how deplorably bad the market is, how it's a disaster, how everything is on fire, in a bad sense, being burned down. Well, the number is actually up $4,450 from the $415,000 at the end of December. So we are already up 1.1%, $4,500 approximately this year. Now, if we were to continue to go up at this rate every month of the year, we'd be looking at double digit, we'd be looking at 12% plus growth in prices during 2023. Now, I've done my market forecast video. I said I believe that the market is going to be relatively flat, putting in a bottom sometime in the first quarter of the year. We may have just seen that with January. It may be that February is actually very flat. February could possibly be up, and that we would then see a strong trend upwards for the remainder of 2023. Now, I did give a major risk warning forecast video as well. Let's hold that major risk aside. We're already overperforming for what my predictions were for 2023. And if you go look at the videos that are out there, I have been more optimistic because I've been looking at the actual data about what's going on in the market and the actual trends that support the data of what's going on in the market than almost anyone else out there who's claiming disaster, who's claiming crashes, who's really trying to scare you because they want you to be as miserable as they are. And apparently there's a lot of really miserable people hanging out in social media. Surprise, I didn't realize that. All right, so we are down from where we were in January of last year. Now you remember January through May of 2022 were very strong uptrend months before interest rates really started clobbering the real estate market here in Las Vegas. And so in January of 2022, we were actually at $433,000, which had been up approximately $15,000, $16,000 from the month before in 2022. So we are down 3.1% year over year. Now we're going to see some challenging comparisons year over year for the first 5 months of 2023, because the first 5 months of 2022 were some of the steepest price increases that we had seen in the rapid run up in prices that we'd seen in the second half of 2020 and all of 2021. So month over month comparisons will be very important this year. In the second half of 2023, we're actually going to see easy year over year comparisons because we were coming down in price in the second half of last year. So all of the annual comparisons this year regarding price in particular are going to be a little bit weird. It's going to look weak in the front end and strong in the second half. So pay more attention to the month over month. Now, the one challenge with month over month data is we're not looking at the seasonal variation that, or we're not parceling out the seasonal variation that occurs, right? Winter is weaker than summer. Spring is strong. Fall is usually a little bit different. It's usually a little bit between the summer and the winter numbers, maybe not quite as strong as the spring. So we do have that challenge when we're looking at only month over month data, but it's going to actually be a more accurate indication of what's going on this year, just because 2022 was in many regards an unusual year. We're going up very steeply in the first half and coming down, not very steeply, but we had come down about 13% in the second half of 2022. We corrected, and that was a steep correction, happened over a short period of time, primarily because of very big changes in interest rates. And I'll talk a little bit more about that at the end of the video when I talk about affordability. Now remember, there's one other way that I like to look at pricing, and that is price per foot. Not because in Las Vegas price per foot is a common way for something to be bought or sold, but because it gives us a peek inside the numbers to be able to better understand the market dynamics. And so we saw median price per foot in Las Vegas at the end of January at $234. That is up 1.7% from $230 at the end of December. It's down 0.4%, 0.4% from $235 at the end of January of 2022. Now, this is the first increase in price per foot since June of 2022. Actually, same thing. First, price increase at the median, going up on the median price since May of last year. But we're seeing this up 1.7% for price per foot relative to median price, up 1.1%. So we're a little bit statistically significantly higher on price per foot than we are on median price right now. We're down only 0.4% from where we were at the end of January last year, whereas median price, we're down 3.1%. So what this suggests is we're actually starting to see return of some of those buyers at the upper half of the real estate market a little bit more quickly than we're seeing return of buyers at the lower half of the market, right? So that's why price per foot's going up a little more quickly than median price, because price per foot takes into account things such as size of home, number of windows, grade of appliances, size of the yard, things that don't necessarily expose themselves in the median sale price, right? Imagine you had two identical homes, identical neighborhoods, but one sat on an acre of land and the other had neighbors all around it, rear neighbors looking into the backyard and everything like that. The houses sell at the same price. Okay, well, that's interesting, right? That means there's no value on the land. Well, what if one of those houses sells actually at a higher price? The houses are identical. The appliances, everything inside them is identical. The neighborhoods are identical. But that one that sold at a higher price is sitting on more land. And that's why it sold at a higher price. So that higher price is going to translate to a higher per foot price because it's the same number of square feet and it's getting a higher valuation in the resale market. So those are the kinds of things that we start to uncover, at least in bulk, in a price per foot measure. And so that's why I say when we see price per foot going up a little more quickly than the median price, we know there's something going on at the upper end of the market, things that are more special on those properties. If we see price per foot going down more quickly, as we saw in a couple of months in the summer of last year, we know that means the top of the market is being negatively impacted by something even more so than the lower half of the market. So that's what we see going on here right now, is we're seeing some return of those luxury buyers maybe a little bit more quickly than we're seeing return of the bulk of the market, and certainly the lower half of the market. All right, so what about number of properties sold? And this is definitely interesting information. In January 2023, single family resale residential in the Las Vegas Valley, the Las Vegas LVR or MLS data area, which actually includes Boulder City, it includes Laughlin, it includes Mesquite, it includes Pahrump. So it's the, if you will, the metropolitan statistical area for Las Vegas. So it's more than just the valley. 1,182 houses sold. Now, that's almost a depressingly low number. That compares to 1,334 houses that sold in December, which was already an astoundingly low number of houses. You had to go back to 2008 to find a number that was as low as what we saw in December of 2022. We are 26% below the pandemic low when the economy was completely closed and people could not leave their homes. This is a really, really small number. Now, this is in addition to being 11.5% below the number in December, this is 52.7% below the number in January of 2022. Before interest rates started clobbering the market, especially the number of sales that were taking place in the Las Vegas Valley. So we're looking at really low numbers of transactions here. Now, I would be more concerned about this, except for the number that I'm about to present to you, which has a significant implication about what we're looking at here. Now, again, please smash the like button if you find this kind of information helpful or useful. Subscribe, hit the notification bell, and now we're going to change our focus. We're going to look at data that derived from January but is forward-looking in time, stuff that tells us about what may be going to occur looking forward. And so we start that with pending home sales. Pending home sales, or contracts. These are contracts that have been written. Buyer and seller have agreed to engage in a transaction. They sign the paperwork, they open escrow, and these remain pending until they actually close. Well, pending home sales then tell us something about what we're going to find for closed sales in the subsequent month. So pending home sales are a great forward-looking indicator. Pending home sales in January of 2022, 1,833. Now that's way above the 1,182 that closed, right? We're up 650 from approximately from the number that closed to the number of pendings that could potentially be closing in the month of February. This is up 48.8% from the 1,232 that had been pending at the end of December of 2022. So we're up almost 50% on pendings. This suggests we're going to see a significant jump in number of sales, number of transactions in February. Some of these may spill into March. Of course, some of them may end up dropping out for various reasons, which we'll talk about when we get to the back on market statistic. But this is a really encouraging sign that for volume, we may have just put in January the floor for what we're going to see as we come out of the challenging second half of 2022. So prices already going up, and pending home sales much higher, almost 50% higher. Now, pending home sales, it's not like perfect information. It is actually still down 32.4% from the pending 2713 that we saw in January of 2022. Right, so we're down year over year, but we're way up month over month. Interestingly, another way to look at this, right, because there is seasonal variation, right? We expect that pending home sales will be going up as we go through the first half of the year, and maybe coming down as we go through the second half of the year, just to account for seasonality. Well, this number, 1833, is actually the highest number of pending home sales we've seen since August of last year, when the market was really starting to cool off because of high interest rates. Prices had started to correct a little bit in June. We saw sales coming down throughout the sort of the last 7 or 8 months of 2022, but we had pending home sales that were lower all the way from August of last year through the end of December of last year. So we seem to be bouncing off of that now. Now, pending home sales, of course, are the contracts that we expect to be closing as we go forward in time. Right? Even if all activity stopped, we would expect the pending home sales, the contracts that have already been written, we'd expect the majority of those to actually close. Right? So it does not tell us specifically what's going to happen 2 or 3 months out, but it tells us something about what's going to happen next month, so the month of February, maybe a little bit of March. But what gets sold, almost everything that gets sold is coming out of inventory. So we need to have inventory in order to sell. So let's look at inventory. 5,674 single-family resale homes sitting in inventory at the end of January. That is down. It is down 17.0% from the 6,839 houses that were sitting in inventory at the end of December. Now, this is kind of interesting, right? Normal seasonal patterns would have us with the lowest inventory of the year generally hitting in December. We're actually seeing inventory continued to come down in January. And there's been a strong downtrend in inventory numbers for single-family residential product for sale for the past 6 months, actually. So inventory has been coming down, and it's kind of interesting. One, we're only at about 50% of normal inventory. So people who've been out there saying, oh, we've got huge inventory and buyer's market, no, that's not true. We've come down. We were always below normal inventory throughout 2022. We've come down and we're at 50% of normal inventory now. We have the lowest inventory numbers since May of 2022. Inventory is up, of course, from where we were with the very constrained inventory that we saw throughout most of 2020, all of 2021, and the first portion of 2022. So we're up 67.3% from the 3,390 that were sitting in inventory at the end of January 2022. But remember, the year-over-year comparisons are going to be really weird throughout 2023. We're going to look weak in the front half of the year. We're going to look strong in the second half of the year. And it's because 2022 was such an unusual year. So take all the annual statistics from me and that you hear from others with a grain of salt. There will be people out there with their videos trying to point everything back to 1 year ago statistics because they look really dramatic to tell a disaster type story. They just don't happen to be indicative of what's actually going on in the market at the current time. So do not allow yourself to be swayed by that misused information. All right, so we're about half of normal inventory. Inventory has been coming down and came down 17% from the end of December through the end of January. Now, another way to look at inventory, and that is number of months worth of supply. At the current rate of sales, which are low, right? In January, current rate of sales very low, historically low. But at that rate of sales, if inventory stopped coming into the market and we continue to have only that number of sales per month, we would have 2.8 months worth of inventory. Now, normal market inventory, balanced between buyer and seller, 5 to 6 months. At the top of the price point and where the market started to turn down, we started to see significant inventory levels because of that. In May of 2022, we had 4.0 months worth of inventory. Now, it's kind of interesting. It means that even in May, even as the sales started coming down, as inventory started building up because sellers were jumping in, trying to sell before buyers left the market entirely, as inventory was going up because fewer houses were coming out because of the slow sales, we only got up to 4.0 months, where balanced inventory is between 5 and 6 months. Well, we're not at 4.0 months any longer. In December, we were at 3.3 months, and we just pulled 2 weeks out of that. We're at 2.8 months worth of inventory. And based on pendings, sales are going up. So we're going to see this inventory number continue to come down. As I'd suggested in my market forecast video, what we're going to see is we're going to see decreasing levels of inventory. We're going to see increasing sales because buyers are going to come back into this market before sellers do. Now, we have inventory that leaves, it gets sold, goes into contract. We have new inventory that comes in, newly listed for sale. In January, of 2023, 2,313 newly listed resale homes came into the market. That's up. It's up a lot. It's up 41.5% from the 1,635 that came into the market in December of 2022. Now, interestingly, seasonally, December is the slowest month for new listings, right? Every year, if you look at a volume chart for new listings, there's a valley, low point, a nadir point every single December. So that we come up strongly off that is to be expected in January. We do seasonally. But this number, 2,313, this is the lowest non-December number since April of 2008. So we're not at normal new listing data in the data set right now. We are not growing inventory through this because other houses are expiring out or they're being withdrawn. And of course, things are going into pending contract and being sold. So this number is insufficient to grow inventory, which is rather interesting. Now, this number also is down 20.5% from the 2,911 newly listed that we saw last year in January. And last year, of course, was still marked in the first quarter by low inventory. So this is significant, right? I mean, inventory is up 67% from where it was last year. So last year at this time was still incredibly low inventory levels. What we got into the market in January of last year, we're down from that. We're down 20.5% from that. Now, last year we started to see inventory build, but we only got up to a maximum of 4.0 months. We're going to see very tight inventory this year. We're going to see buyers this year, and we're going to see a lack of sellers. Why do I keep saying a lack of sellers? In this market, where interest rates are 6, had been up to in November 7.4%. They're 6.10 right now, 6.12, 6.09, depending on what day you're looking at. Average 30-year fixed rate interest rates across the country. Is interest rates continue to stay in this range, probably very high 5s to very high 6s for most of this year, we're looking at sellers who are sitting there in their houses now with interest rates of 2.5%, 2.25%, 2.75%. And a lot of them are thinking to themselves, my house is acceptable. Maybe I can do some repairs, some upgrades to it. But if I sell it, I'm going to end up with a higher interest rate on the next house. And so that does not mean nobody will list their houses, but it does mean a significant number of people who might generally be thinking of moving across the valley or maybe getting a little bit bigger house or a little bit smaller house. They're kind of going to be stuck in place until they get over this desire to keep their really low interest rate. There's another issue as well. Coming out of the financial crisis in 2011, 2012 timeframe, there were a lot of institutional buyers that came in and bought up a lot of properties in Las Vegas. And this is a long-term issue, right? I'm talking 10, 11, 12 years ago now, that these buyers started to come in and started buying up thousands of units. And something probably close to 20,000 houses, single-family houses in the Las Vegas Valley, now they're out there as rentals. And they have been for a decade, or some of them for only 5 years, or whatever. Those houses are not coming back into the market because those institutional investors love the cash flow on those houses. And the rate of returns are really high because they got those houses at very depressed prices coming out of the financial crisis. So those houses that we might normally expect to see coming into the market, they're not going to be coming into the market. This is a long-term structural transformation of the market in Las Vegas. And we started seeing these inventory constraints in 2019. Houses that we would have been thinking would be coming into the market were not coming into the market. We can think the average homeowner owns their house between 3 and 10 years, right? So about 5-6 years into home ownership, we should be expecting to see houses rotating, the same houses they had been bought and sold previously, right? And if we take 20,000 of those out of the equation, right, divide 20,000 by 5 years, that's 4,000. 4,000 houses every single year that should be coming on the market. Structural change prevents those from coming into the market. They're not coming into the market. Now, I'm not talking about the flippers. I'm not talking about maybe the Zillows or the Redfins or the Open Doors who buy up properties with the intent of doing just a little bit of work and then turning around and selling those properties for a high profit potential. I'm talking about the institutional investors who came in and bought up properties. It's a long-term business proposition to buy, hold, and rent. And those properties are just, they're not coming back, right? And so that's inventory, housing inventory, that's not going to be coming into the resale market. That structural change, along with people who feel locked in because of their really low interest rates, that's going to continue to be restraining inventory, for sale, resale inventory in the Las Vegas Valley for years, probably for decades. And buyers, every time somebody moves to Las Vegas for work, for retirement, they need to live somewhere. And so we've got people who are needing to live somewhere who are arriving. And of course, we've got generational shifts which are causing people to want to move out of their parents' homes, start their own households. Maybe that means roommates who decide to go out, and they had been roommates in one place and they each go out and rent or buy something on their own for their own privacy as they become more, I don't want to say this pejoratively, but feeling more like they want to be independent adults. So we have demographic issues on the buy side, pushing up number of buyers, and we have structural issues on the sale side, pushing down inventory. These are long-term trends. We can see variation from month to month, from year to year, but they're still long-term trends. That's why we only got up to 4.0 months worth of inventory at the high inventory point in 2022. We didn't get back to normal market. And that's why we're seeing now inventory levels have come down to 2.8 months, even in the incredibly slow sales environment that we put in January of 2022. Next data point, back on market, 697 single family homes that had gone into contract, and I'm only talking the resale side, that had gone into contract and should have closed, failed. 697, that's 37.1% of contracts failed. That's a really high number. We had watched that trending down to about 30% in late 2022. This has jumped. Now, this provides some evidence to support my belief as to what's causing some of these back on market problems. I had been suggesting that back on market was elevated significantly in part because of bad appraisals, because of appraisals coming in below contract levels. And when that happens, it can mess up a buyer's financing, or it can give a buyer cold feet when the buyer suddenly feels like, well, wait a minute, I was going to pay X and this is coming in several $1,000s less than X. Maybe I'm overpaying. And if seller and buyer cannot negotiate back to some solution, buyer walks, gets all their earnest money deposit back because the appraisal is a contingency under the contract, generally speaking. And so the contract fails, and seller has to go out and either adjust their pricing back in the market, pull their house entirely off the market, or do something else because the appraisal failed. Well, there's other reasons that contracts fail. There are inspection problems. So sometimes inspections are going to uncover things that are really about buyer desires that buyers had not been able to conceptualize previously. Sometimes they're going to uncover things that are actual really big problems. Sometimes they're going to uncover things that sellers are not willing to negotiate over, or the buyers are being unreasonable about. So inspections become a significant flashpoint that creates back on market conditions. Sometimes a buyer loses a job, and so they lose their ability to finance the property. Sometimes it's been interest rates have been going up, and they had been going up so quickly through much of 2022 that sometimes buyers would get a pre-approval letter, start looking for a property, get into a contract, and at the higher interest rate they can no longer qualify. Right? So there's a number of things that cause back on market numbers to exist and to become elevated. But normal number is about 10 to 15%. We're sitting now at the end of January at 37.1% of all contracts being written are failing. Well, prices in January started going up on closed contracts, on actual sales, to the extent that appraisers are listening to doom and gloom on YouTube or listening to podcasts that are talking about disaster. Appraisers are behind the curve, and they're not recognizing that prices are going up, and some of those contracts, buyers and sellers are recognizing prices are going up, and the contracts fail because of appraisal problems. And so that had been a really big issue in 2021. It had been a declining issue in 2022 as we started to see price increases moderate in sort of the April-May timeframe, and then prices coming down. Now that we're seeing prices start to turn around and go back up, I suspect we're going to see more appraisal problems. So make sure you're working with an agent who understands how to deal with appraisal challenges, and make sure you're working with an agent who understands also how to get through negotiations on requests for repairs coming out of inspections. Two really important things. Now, the one other issue that I want to talk about in this video, I've been mentioning it for the past 18, 20 months or so. It's become something that gets talked a lot about in the environment. A lot of people throw this around as really negative information about the housing market and why things are going to crash. And that is affordability. And I have continued to say affordability is a made-up construct. Yes, it is certainly true some people cannot afford to buy a house. It is certainly true that housing costs may be higher or may actually take more of your budget than you would like for them to. But affordability is still a made-up construct, because most people, when they buy a house, they are buying a house with a mortgage. And that means they don't need to come up with the $419,450 of the median home out of their pocket. They're going to take out a loan. And so affordability actually needs to look at what's the monthly payment. Now, banks may use various calculations, such as a debt-to-income calculation, which looks at not debt actually, but rather your monthly minimum payments that you're maintaining on your various bills that get billed monthly, non-utility bills, non-tax bills, and compare that to what you would be able to afford with their particular debt-to-income limit for buying a house. But that debt-to-income limit is something that's a little bit fudgeable. So there are federal guidelines about what borrowers need to be at or below in order to qualify for a loan. But there are plenty of what are referred to as non-QM, non-qualified mortgage loans out there that bring that down. Also, there may be types of loans that have lower interest rates. And if the interest rate is lower on the loan you're borrowing, let's say because it's a 5/1 ARM, adjustable rate mortgage, then that's going to lower your monthly payment on the mortgage, which is going to lower your debt to income ratio. There are also banks out there that will lend without regard to the formal federal definition of what's a permissible debt to income ratio. They'll allow you to go higher on that debt to income ratio. And then there are other products that most people aren't really aware of that can allow for lower interest rates by lowering the time duration of a mortgage without increasing any kind of reset risks on the rate on a mortgage. And remember, most people are in their houses between 3 and 10 years. If you were to borrow on a 5/1 adjustable rate mortgage, it does not reset until the 5th year, which means that it could be in your house with effectively a fixed interest rate payment during the entire time of ownership of that home. So there are ways to adjust what your payment's going to be. So affordability is a manufactured concept. Nonetheless, lots of people like to talk about it. It has some interesting aspects to it. And one of the interesting aspects is how it compares over time. So over the past few years, I've repeatedly mentioned that the prior peak in housing, prior to this cycle where we got up to $480,000 in May of 2022, the prior peak had actually been in June of 2006 in Las Vegas. And that number was $314,700. Now, it's an interesting number, but you have to adjust it for today's dollars so that we can make comparisons to today's prices. So we have to inflate or deflate that number. So in current year dollars, that number is $448,000. So we're below that on actual purchase price right now. We're just below $420,000. So we're $28,550 less than what we were in June of 2006. But that's not the full story because, again, most people buy a house with a mortgage. And so we have to look at what the mortgage interest rates are. Well, let's look at it not specifically back to 2006, but let's look at it relative to the peak in 2022. At the peak in 2022, May of 2022, we were at $480,000. We've come down from that $60,550, right? So it's a substantial drop. It's a 13 or so % drop in the purchase price of a house. But in May, we were looking at a mortgage interest rate that had gone up substantially from the beginning of 2022. It had gone all the way up to 5.33%. Now, we're higher than that now, but 5.33% for a conventional 30-year fixed rate loan. And let's say we took out a 90% loan to value loan. So we put down 10%, $48,000, and we borrowed the remainder of that to buy that property. That came out to a monthly principal and interest payment of $2,391. Now, interestingly, that number happens to be $204 less per month than the carry cost on the purchase in June of 2006. Again, if we inflate to current year dollars and look at the average interest rate at that time. But so we were a little bit less expensive, $200 less expensive in May of 2022 than we were in June of 2006 for a carry cost. So we never actually got back to that same level of monthly expense. Well, we've come down from that, right? We're no longer at $480. We've come down a little over $60,000, and interest rates have gone up. At the end of last week, interest rates were 30-year fixed rate, average across the country, 6.11%. And so if we take a 90% loan to value on the $419,450 purchase price for the median home last month, that gave us a monthly mortgage payment of $2,273. Now, that is $118 less per month to carry that property than it had been in May of 2022. Kind of interesting, and we come down a little. Actually, what we saw in June, July, August, September, October, November, and December, the monthly carry cost during every one of those months on the median price home, as the median price was going down, but interest rates were going up, every month it was within $5 of what it had been at the peak in May, which meant that what we were seeing last year wasn't crashing prices. It meant that what we were seeing last year was consistent monthly cost of carry on those properties. It's kind of interesting. Now, we actually, because interest rates came down kind of substantially in January, even though we saw prices go up in January, we actually have come down $118 from that sort of median level that we'd seen in the second half of 2022. So about $100 a month worth of savings. Not a whole lot, but it means that actually literal affordability has improved. Now, I do not think that's going to continue throughout 2023. I think that we're actually going to see monthly payments going up. I suspect interest rates are going to vary this year. Mortgage interest rates will vary this year from probably about 5.9 up to about 6.9. And we'll see prices going up most of this year. So I think that the monthly carry cost will also go up. But I think we're going to start to see some innovations in mortgage products over the next 2 or 3 months, certainly by April, May timeframe of 2023, which is going to help address affordability and therefore help to show that it's this illusory concept, that it's not a cut and dried kind of issue that we just know things always get more expensive, because that's not actually what the case is. Okay, so that's it. A couple things. I am Justin Miller with the Chong Miller Group. We help people build wealth through real estate. We help people buy and sell homes. If you've got questions, please reach out to us, leave comments. I'd be happy to talk with you and see how we can help you in your real estate adventures. When you're evaluating real estate agents, make sure there are people who actually understand what's going on instead of being caught in the hype of the moment. Make sure there are people who understand how to get through appraisal issues, how to get through inspection issues, because you want contracts that you get into, whether you're a buyer or a seller, to be successful contracts. I look forward to seeing you in the next video. Thank you.